Welcome to the Financial Power Play, the podcast where hockey meets real life money talk. I'm Brett from Uptown Wealth Management, here to help hockey families and professionals create a financial game plan that works on and off the ice. From the rink to retirement, this is your go-to for real stories, smart strategies, and trusted advice. Let's drop the puck and dive in. Welcome to the Financial Power Play. I'm Brett Cranson. Thank you for joining me today. This episode is about a part of financial planning that many investors skip: insurance. I know it's not the flashy topic, it's not the fun part of investing, but it is the part that holds the whole plan together when life hits harder than the markets. Your life changes faster than your portfolio. Your job can change. Your health can change. Your income can change. Most people forget that. They talk investments first. They talk returns first. They assume insurance is optional. Today, I want to show you why that idea creates risk. And I want to give you a simple way to review your own plan. By the end of this episode, you will know exactly where insurance fits, what to review, and what to ask your advisor. Before we go deeper, small compliance reminder. This is for education only. Use your own numbers. Use the tax rules for your province. Every family is different. I want you to use this episode as a thinking tool. Quick note for listeners. Grab your notes app. Write down 4 things: your income, your debts, your dependents, your fixed monthly bills. Just those 4 items tell you where your pressure points live. All right, let's get into it. Many people assume the only risk to their plan is the market. They focus on volatility. They focus on timing. They focus on returns. But markets are only one type of risk. Life events are the other. And those events can hit harder than any correction. There are 3 plan breakers that investing alone cannot fix: early death, long income interruption, a major illness that creates out-of-pocket costs, and time off work. I want to give you a simple example. Imagine a household making $210,000 per year. Mortgage is $780,000. 2 kids in sports, costs around $14,000 a year. Fixed bills total $10,500 a month. Now ask yourself, if income drops by half tomorrow, what breaks first? Is it the mortgage payment, the groceries, the sports programs, the retirement contributions? Most families cannot carry that drop for long. And that is the point. Investing alone does not cover this risk. A real plan covers both market risk and life risk. Peace of mind in financial planning means one thing: the plan survives bad timing. Cash flow stays stable when life hits. Goals stay funded even if income stops for a while. This is what insurance creates. It buys time. It protects choices. All right, take a moment right now. Rate your plan strength from 1 to 10. If one income stopped for 6 months, do not overthink it. First number that comes to mind. All right, let's go deeper. Life insurance is simple. It covers the things your income normally covers. It replaces your income if you die. It pays off debt. It keeps your kids in their activities. It covers final expenses. And it can support tax planning in certain cases. And 2 myths show up all the time. The first, I have investments, so you don't need insurance. And the second, I have work coverage, so I'm covered. Both can put a plan at risk. Here are the real questions to ask about work coverage. Is it portable if you change jobs? Is the amount enough to cover mortgage and living costs? Does it reduce when you are off work? Does it end at a certain age? Most people do not know the answers until a crisis forces them to learn. You can avoid that by sizing the problem first, not the product. Make a needs list. Debt payoff target. Years of income to replace. Your child costs. And one-time expenses. Do this before talking about products. Here's a simple case study. A parent dies at 42. The surviving spouse keeps the house. They want to keep the kids in sports programs. They want to keep retirement contributions going. Without insurance, the spouse sells investments in a down market to pay bills. Retirement plans suffer. Cash flow breaks. Stress spikes. With insurance, the benefit covers the cash flow gap. Investments stay invested. Goals stay on track. That is the difference. Not theory, real life. Let's keep it simple on product types. Term insurance covers a set of period. Great for protecting mortgage years and child raising years. Permanent insurance lasts longer and can support estate goals and tax planning when needed. Choose based on the problem you are solving, not the product label. Here are the questions to ask your advisor this week. If I die this year, what happens to the mortgage? What happens to childcare? What happens to your monthly budget? What happens to the long-term plan? What coverage do we have now, and where are the gaps? What does the payout process look like, and who helps my family? Here's some action steps. Text your partner this right now. If something happened to me, could you run the household for 6 months without changing your life? The answer tells you everything you need to know. All right, let's move on. Your income funds everything. Your portfolio came from your income. Your goals depend on your income. If income stops, everything feels pressure. Disability can look like many things. A physical injury, a chronic illness, a mental health leave, a recovery period that lasts longer than expected. High-earning families feel this more. Fixed costs are higher. Kids' costs continue. Retirement contributions pause. Debt grows faster. Here's a case study for you. One income household. Salary is $180,000. Injury forces 10 months off work. Emergency savings cover 3 months. Without disability coverage, they pull from investments, pause RESP and retirement contributions, and add debt. With disability coverage, bills stay paid, investments stay invested, the long-term plan stays intact. Here are the key features to understand. There's a waiting period. How long before benefits start? The benefit amount. The percentage of income replaced. The benefit period. How long benefits last. And definitions of disability. What unable to work means for your specific job. Group plan coordination. What work covers and what is missing. And here are some questions for your advisor. If my income stopped tomorrow, how long until we sell investments? How long until we miss a mortgage payment? How long till we pull our kids out of programs? What work coverage do I already have? Is it enough for our fixed costs? If I change jobs, does the coverage follow me? And here's an exercise for you. Open your banking app. Add up your fixed monthly bills. Divide that by your household take-home monthly income. Write down the percent. That number is your fixed cost load. It tells you how much stress a pay interruption creates. Okay, moving on now to critical illness insurance, which pays a lump sum if you're diagnosed with a covered illness. You can use the money for time off work, treatment, travel, private rehab, home support, income gaps, or paying down debt. It is not a replacement for disability insurance. It does not cover every illness. It does not replace emergency savings. It gives you choice. Even with Canadian healthcare, costs still show up. There's travel, accommodations, time off work, a spouse adjusting hours to support care, recovery that changes work capacity. All right, here's a case study. A person diagnosed at 45. 8 months of recovery creates $45,000 in extra costs. A critical illness benefit lets them keep the mortgage, steady, fund travel, and avoid cashing out investments. And here are some questions to ask your advisor. What would the next 6 months cost us if I had a major diagnosis? How much cash would reduce stress the most? What coverage do we already have? What exclusions matter? And here are some action steps for you. Write a short recovery budget. Mortgage, groceries, travel, childcare, missed income. That list gives you clarity. The right sequence matters. Start with goals, your retirement timeline, keeping the home, supporting your kids, flexibility to change careers, then list the risks that block those goals. Death, disability, illness. Then choose the tools that protect the goals. Insurance, emergency savings, debt strategy, investments. Good advisors ask better questions. They use your numbers, they show trade-offs, they document the recommendations, they revisit it every year. How do you know you are properly covered? Perfection is not the goal. You want coverage that prevents forced bad decisions, like selling investments at the wrong time. In a real planning review, insurance sits beside cash flow, investments, tax planning, and estate planning. It is part of the agenda, not an afterthought. If your advisor does not offer insurance, they can still coordinate it. They can partner with a specialist. Your plan still needs the coverage conversation. All right, let's finish this strong. Day 1, inventory what you already have. Your work benefits, your personal policies, your mortgage insurance details. Day 2, create a 1-page snapshot of your income, your debts, your monthly fixed costs, your dependents, savings and investments. And on day 3, identify your 3 biggest vulnerabilities. If I die, if I cannot work, if I get seriously ill. And on day 4, book a review meeting. Ask for an agenda that includes life, disability, critical illness, and beneficiaries. And on day 5, ask 5 questions. What happens to our plan if one income stops for 12 months? What is our coverage gap in dollars? What do we have through work? What changes if you switch jobs? What is the lowest cost way to cover the biggest risk? Day 6, decide the next steps. Get quotes, compare based on the problem solved, confirm underwriting requirements, and on day 7, implement and document. Store policies, store beneficiaries, share locations with your spouse or trusted person. Investments grow wealth. Insurance protects the plan. Protection keeps you from making expensive decisions under stress. If this episode raised questions for you, book a risk review and bring your one-page snapshot. It will make the meeting efficient and clear. Thank you for listening to the Financial Power Play. You have what you need. Now build your plan with confidence. Thanks for tuning in to the Financial Power Play. If this episode sparked something for you, be sure to subscribe, share it with your hockey crew, and leave a review. Want to talk about building your own financial playbook? Visit uptownwealthmanagement.com to book a free consultation. Until next time, stay focused, stay flexible, and keep playing your game.